Good morning. Welcome to Wise Insights. It's been a pretty volatile week so far. We have the Fed's Jackson Hole Symposium speech coming up on Friday. So I think the market is a little bit anxious going into that speech by Powell, especially after a bad set of non-farm payrolls and equities still making new all-time highs early in the month. So we're going to first look at what happened this week, and then going through the FOMC projections, as well as a high-level analysis of the stock market and across asset currents before we move on to the charts today. So let's begin. It has been a pretty ugly week so far. We can see that all of the major asset classes sort of since the beginning of the Monday, led by cryptocurrencies first. So IBIT dropped pretty rapidly over the weekend, but also then into the Monday open. And things started to accelerate on Tuesday. You can see that SPY, QQQ were largely stable on Monday, marginally down. But on Tuesday, things started to move down much more firmly, and that actually even included gold. But once they saw the final divergence where SPY, QQQ capitulated at the open, and then gold actually moving sharply higher as investors rotated out of equities market into gold and even bonds to a smaller degree as safe haven assets. About 30 minutes into the day, crypto began to see a bid. Bitcoin, Ethereum all started rallying in the early morning, and then after 10:55, SPY and QQQ, so the equities also go bid up, and we see almost a V-shaped recovery for the day, ending the day marginally down. So it wasn't that bad, but the intraday candles did look pretty horrendous at the time. So now we have Friday's speech coming out by Powell. This is usually a very good opportunity for the Fed to review its progress since the past year, talk about the larger framework stuff. For example, they talk about flexible inflation targeting before putting the Fed's target, not just 2% target exactly, but a 2 to 2.5 range instead for the policy flexibility. So that used to be one of the topics. This year, this is Powell's last Jackson Hole speech. So I think he wants to talk about legacy stuff. By that, I mean reviewing his tenure as the Fed's chairman in the past 10 years, the progress it has made in terms of the policy framework, dealing with pandemic, and also keeping inflation back in line in the past few years. So I think he probably wants to avoid talking about the exact expectation for the upcoming meetings. The September meeting still has a couple of data sets before the meeting for the Fed to review the next set of non-farm payrolls at the beginning of September, as well as the CPI figures. Until the Fed reviews both of these sets of data, they don't really want to firmly commit to a cut just yet. And of course, if the labor market deteriorates further and employment rate shoots up again, the Fed could consider committing to the 25 basis point cut. But right now, I think even though the market is expecting a full cut, Powell would be wise not to corner himself into it just yet. Although it wouldn't be exceptional, given this is a big speech before the next meeting. Although I don't really see the upside for him to do that because the market is already expecting a full cut. Why not leave yourself with some flexibility going into it? Now, just looking at the FOMC decisions priced by the Fed Fund futures, and we're looking at about 5 cuts, 25 basis point cuts in the next 12 months. So that is a slightly more aggressive than where we started at the beginning of the year, which is about 3 cuts to 3 to 4 cut range. And it does assume that inflation is coming back in line with the Fed's expectation. So there is a good chance that we can dial back this expectation after Jackson Hole or even the next set of non-farm payrolls, because inflation is still not quite definitively moving inside the Fed's target. So there's still some stickiness, and there is a worry that the high PPI that we saw early in the month could translate to high CPI this month and next month if the retailers decide to pass on the cost into consumer pricing itself. So now, if we zoom out for SPY, well, so we've had a quite volatile week after reaching the all-time highs. But if you just look back the past couple of years, I think we only touched the 200-day moving average twice. The first time, it was a very definitive buying opportunity, and the second time, it moved much further. But even if you bought at the 200-day moving average, you still be up after holding out a few months. So we are not even close to touching the 50-day yet, let alone the 200-day moving average in this uptrend. So the overall trend is very bullish. If you're looking at the dip buying at the 50-day moving average, that has also been a pretty simple but effective trade. So again, we are nowhere near reaching both of those levels. I think, of course, a lot of people on the sidelines who are not fully invested want to see a big retrace into the 50-day and ideally into the 200. We could possibly get that, but until we get there, I think it's not productive to preempt what the market is going to do and whether we have topped. And also just looking at the market breadth. So this is the top line is the SPY's price since 2023. And the bottom line is the percentage of the constituents being above the 200-day moving average. And we've actually gathered all the data individually to compute it ourselves. And so this is an organic chart that I've compiled. And what we're looking at is that when the market breadth starts to deteriorate, we could get local tops here and here. And then when the breadth starts moving up, we're seeing a fairly sustained bull market moving along, right? So if we look at what happened since April, we are seeing S&P 500 moving into new all-time highs, and the participation is actually also broadening with it. So we're seeing more and more companies moving above the 200-day moving average in this bull market, and we're not even at the extreme levels yet. So when I say extreme, I'm considering those 80% mark or even high 70% mark as places to be a bit more cautious, but we are not even there yet. So this pattern here is consistent of the middle of a bull market rather than the end to me. So I do think we haven't finished. We could get a deeper pullback, sure, but I do think we're going to make a new all-time highs at least this year. So now we're looking at more cross-asset for Bitcoin and gold. This is the Bitcoin and gold's rolling one-year return since the beginning of the year, but adjusted for the volatility. The reason I've done it this way, rather than just the absolute performance, is that Bitcoin is a more volatile asset class. So if you look at Bitcoin's performance, it doubles year after year, but at the same time, it's very difficult for investors to hold on to the drawdowns because it's just so volatile. And it's not that useful to compare something that's 20 trillion in market cap like gold versus 2 trillion in market cap like Bitcoin without accounting for their respective volatility. So obviously, the more mature asset class would have less volatility because there's more money participating in it. There's more institutional investing. Investors, a lot of fast money won't move the needle as much in a much bigger part of liquidity. So what's interesting is that Bitcoin and gold have performed very similarly year to date on a 1 year rolling return basis. And what we see is that when the two performances get close, so when Bitcoin is just catching up or at gold's performance on a volatility adjusted basis, Bitcoin tends to sell off. And we saw this in July when they were almost touching, and we also saw it this month when Bitcoin just briefly overtook gold in terms of performance. And what I suspect is that because Bitcoin is deemed the digital gold, which I do think is fair, and it has a younger class of investors, but because it's being compared with gold as a store of value, when Bitcoin reaches the gold level in terms of performance, I think investors are thinking, given the broader macro conditions, is this outperformance warranted? Or is Bitcoin now getting into the expensive area versus something like gold, where all the central banks are buying? So I think over here, there is a little bit of a natural resistance for Bitcoin to overtake gold in terms of performance. And that is just an intuitive observation. Obviously, if different analysts could have derived different conclusions from this, but I do think this isn't quite just a coincidence in terms of what we see. And also now looking at the credit risk-on proxy. So I'm using the high yield ETF versus IEF, which is the short end of the treasuries curve. When this spread goes up, it means investors are buying a lot of HYG, which moves inverse to the credit yield. So investors are willing to accept a lower credit yield on risky companies compared to the US Treasuries. So what we are seeing is that there was a substantial weakening in this proxy from February going into April. So if you were tracking this closely, you can see that actually we were entering a period of risk off, and you could potentially cut out your risk in stocks ahead of the major capitulation. Over here, we are seeing a slight local top in this risk-on proxy, and we haven't quite moved past it since. So that suggests to me that potentially near term, we could get a bigger pullback in equities, unless, of course, HYG turns back up and make a new high again. But in terms of this consolidation and a slightly weakening in terms of the lower highs and lower lows, it does get me a little bit more worried for the near term. And I will go on to the chart analysis in a second, talking about the potential pullback. Finally, we are looking at the correlations between the macro assets. The top one, UUP, is the dollar ETF. And we are looking at this one primarily, so how bonds trade with stocks and other assets. And what we see is that bond TLT is trading negatively to SPY and QQQ, although quite neutral on Bitcoin. So what this suggests is that, so because TLT, the bond price is inverse of yields, it means lower bond prices and higher yields correlate to higher equity performances in SPY and QQQ. And this may sound counterintuitive because people always assume that higher yields are bad for equities. So that relationship is very, very context dependent. If the market is primarily concerned about the strength of the economy and its impact on risk assets, then if the economic data are bad, the market would expect Fed to cut rates soon and more pricing in more rate cuts, and then therefore lower yields and therefore also weaker equity returns in that environment, and vice versa. So if the in this particular context, investors are bullish on the economy, they're seeing promising data, and therefore the Fed's not going to cut rates as aggressively as previously expected, yields go up, and the stock market also goes up. So that's one of the ways you could look at it. Another way of thinking about it is that currently investors are switching between a risk-on, risk-off regime. So they're selling bonds to buy risk assets like stocks. Therefore, their prices are negatively correlated. And when they feel risk off, they're selling stocks and buying bonds. And you can see that regime also playing out in gold. So TLT and gold actually exhibit a positive correlation in the past month because investors, when they are panicky, they're selling SPY and QQQ, and then they're buying gold here. And actually, what's also interesting is that if you're looking at crypto is highly correlated with the high yield credit ETF, stock markets, SPY, QQQ, and IWM. So this again shows that investors are buying crypto based on sentiment, their risk appetite, along with other risk asset classes. SPY, we have written this trend line at the beginning of August. And for me, unless this trend line is breached, then we don't definitively have a wave for pullback. So the intraday candle actually just touched this trend line support, but it didn't quite break below it. So for now, we can't rule out that wave 3 could further extend, although this wave 3 is already in a stretched territory above the 1.76 for extension of this wave 1. So, so for now, I am watching whether we can breach this support line before really considering the wave 4 target. But if it does, and this is what I'm looking at a retrace down to the 610 level as a minimum for wave 4, and potentially down to 590 level for a deeper pullback. And in percentage terms, we're talking about 5.5% if it gets to 610, and about nearly 9% if it gets to 590. And these are not really big bear market moves. So I would still be quite comfortable with the medium-term bullish outlook, even if we trade all the way down here. And that would test the 200-day moving average around this level as well. So we have plenty of volume profile supporting this region. And I don't really see SPY breaking below the 200-day moving average. QQQ, the QQQ run-up in wave 3 was much more aggressive and faster than SPY. So it was nearly 200% extension of this wave 1. Now, it has breached the trend line support that we've mapped out from May onwards, but it did close right above it. So does this count? I really do think it depends on today's reaction. If we can get a positive green candle up here, then I think this support trend line still stands. But of course, if it falls through it, or if we close below it, and I think we're really looking at a wave 4 retrace with a minimum target of 540, and it could potentially trade down all the way down to 518. There is a bit of a bigger volume profile over here in these regions, and the 200-day moving average. So that should provide a solid support and a brilliant buy the dip opportunity for the final wave 5. So I think it's just key to watch how the market moves on from here. What I have observed in the options market is that investors are buying a lot of puts in SPY and QQQ. And what this means is that they are worried about the downside and they're trying to protect themselves. However, they are not in a full panic mood, because if you look at the individual components of the Max 7 stocks, actually there are far more calls than puts, and there's a lot of positive delta adjusted flow. So I think investors are still bullishly positioned for individual stocks, but they're trying to hedge at the index level in case we do get a bigger wave 4 pullback. Now looking at oil is not a really pretty chart. After failing to break through this high here, we appear to be more of a downward trend now below the 200-day moving average. And I think this could be a downside of 1-2 wave, and we're in the middle of a wave 3. And that would corroborate with our fundamentals analysis in terms of the excess supply in the oil market from both the OPEC and the non-OPEC countries, versus a lack of demand globally this year and even next year. So I think the near-term path for oil now looks more towards the downside, especially now we breached this low from June. And so we could be testing the 60s region. Just looking at a broader structure here, it seems to be a series of ABC triangles, and we are really just in a very wide sideways consolidation range between 60 and 90 here. So I think that the simplest trading strategy is to sell near the top. You could take profit in the middle, and then buy back at the lows and take profit in the middle, or you can hold all the way to the low, up to the individual appetite. But in a very range-bound regime, I think mean reversion is basically the most effective strategy for oil. PLT, very interestingly, machine learning model had turned bullish after Monday. And actually, I couldn't quite figure out why myself, looking at the chart. It didn't really scream that bullish, but we've had 2 constructive days for TLT. I think the machine must have inferred from cross-asset data in terms of how equities were moving, to think that bonds could rally in the short term. If we're just looking at how we've played out as a range, we're looking at a triangle here. And I do think this, in the medium term, is a bearish triangle because of the medium term trend. So the larger degree move is still towards the downside, but we could be pushing higher in the near term towards the upper side of this triangle. In terms of the options market, it is quite core heavy. So near term, for the near term expiries, investors are bullishly positioned. What could change my mind about the medium term outlook? I think, if we break out of this triangle here and also this channel trend line, that would be the first steps for a more constructive outlook for bonds. And of course, if we get above this high here, that would be much more definitive to say, okay, we've had the bottom for bonds, and now we're looking at a much more bullish market for bondholders. The fundamental issues of the US Treasury issuing large number of long-term bonds potentially hasn't gone away yet, even if they are swapping out long duration into the shorter duration. I think the implementation of that strategy to artificially cap the yields require more time and evidence to prove effectiveness. Looking at Bitcoin, I did think that this failure to substantially rally from the last autumn high was a little bit disheartening. We are now looking more likely at a expanded or running flat. What that means is that in this wave 4, we have the ABC 3 legs, where wave B actually travels slightly above the beginning of wave 3. And this wave C now could land at 100 to 123% extension of this wave A, which puts us in the 110 to 113K region as the termination or the bottoming region for this wave 4. And it has found some support in this box here that we've highlighted. So I am cautiously bullish still for us to make a new wave 5 high. Looking at the ETF spot flows, we're still seeing daily inflows, apart from one of the days, of institutional investors buying into spot Bitcoin ETFs. And also the latest drive, as we've seen in the past, was driven by the liquidation of leveraged loan positions. So investors or traders were getting too greedy in the outlook, and they got wiped out in this episode. So for me now, I'm trying to see if we can get some constructive bottoming position in this low region here. I'm looking at the IBIT options. The investors are bullishly positioned in the crypto ETFs. So overall, my outlook hasn't quite changed, but there has been a delay in the timing. Although a week ago, I did highlight that this past 2 weeks was a seasonally weak period for Bitcoin in terms of its historical returns. And the end of August is a lot more constructive. So as we move towards the end of the month, I do expect a constructive bounce here, and then finally getting us to the wave 5 high. For Ether, it's now moving very nicely within this upward channel. Of course, it's touching the upper bound, it's moving sidelines now towards the middle, and that's perfectly normal in a rallying phase where a lot of people made a lot of money very quickly, and we've just breached that 4,200 mark, which was the December top. So people taking profit over here is pretty natural phenomenon. So I could see a pullback here, consolidation phase before the next leg higher. We could see Bitcoin moving first and then Ethereum catching up again. But ultimately, I do think we can get to 5,600 or above in the wave 3 target. Solana actually has been weaker in relative strength because all the hype recently has been built around the Ethereum treasury companies, and BlackRock is not interested in doing a Solana ETF this year just yet. So Solana feels a little bit being left behind in terms of the rally. However, just looking at this chart, I do think we are still in a constructive phase with more legs to go in the bull run. And we had a wave 1, wave 2 here, finishing in June. And I do think we can get to wave 3 in the high 300 levels. It's just taking a bit more time right now, given all the noise is focusing on Ether. Looking at Coinbase, we had a poor set of earnings outcome, but this was largely expected, given that Coinbase almost always sells off after earnings. And then we tried to rally into a gap fill, which failed. And now we are making just a new low on the intraday basis versus this August 6th low. So I think this wave C has to be moved here. And I'm not even that confident anymore that we are in the wave C here, whether this is a 3-wave pattern or potentially moving into a 5-wave pattern. And that could be a zigzag for wave 4. So we can get a bounce, more of a sell-off, rather than directly moving upwards in wave 5. And then secondly, just think about the volatility. So Bitcoin is volatile, but if you actually look at Coinbase, it is an even more volatile asset. So Coinbase tends to overshoot when Bitcoin rallies and then overshoot to the downside when Bitcoin corrects. What that means for investor is, for your positioning, consider a volatility adjusted sizing instead of equal sizing. So that that means for a less volatile instrument, you could put more money in it. And for a high volatile instrument, you can put less money in it. And the impact of your portfolio will be similar across both assets. So when we have a big drawdown in Coinbase, it doesn't affect your position as heavily because it's more volatile. So that's just my 2 cents. Portfolio construction is a huge topic. Everyone has their own methods. So we won't go into too much detail there. So there is a slight chance we have topped in this wave 5, just at 1.23 extension of this wave 4. So if we did top, then I could expect a bigger pullback in wave 4. But right now, as we're holding this smaller degree wave 4 low, there is still a good chance we can reach for this wave 5 high in the near term. But if we breach this, I think we should start considering this wave 5 being complete for this wave 3, and then a broader pullback for this wave 4. So we're not quite there either way. And I think we should just observe a bit more patiently here. Moving on to Apple. Apple had a very relentless rally since the beginning of August. And in terms of volatility adjusted basis, I know this 5% or 4% doesn't sound a lot compared to other big companies, but for Apple, it is a very high standard deviation move. So these are outlier moves, which shows very strong momentum and a breakout to the upside. And I think we should see further follow through towards the 1.382 extension target in wave 3 that puts us at 260 above. So I'm pretty bullish for Apple now. And I think on there could be a lot of rotation going on from the Microsofts and the Metas of the Mac 7 into the laggards like Apple. Looking at Amazon, I have been bullish for Amazon since we reached this low here. I think it's going a simple retest, and I do expect 250 plus wave 5 target to be reached in this move higher. Could it test the 200-day moving average? So now this 200-day moving average is actually above the wave 4 low. Even Amazon does test it, it wouldn't break the overall structure yet. And in terms of the fundamentals, Amazon should be considered basically as an AWS stock, because AWS provides the highest margins and the best growth rate. So in terms of valuation, that is the highest dominant component of Amazon's valuation. So when I look at the news about its deliveries, e-commerce, and all that stuff, I don't really care about that side of the business as much as how Amazon does with AWS. And in terms of valuation, then in that sense, if you think about Amazon as AWS plus a Walmart type of business, e-com, then the stock is easily worth a lot more than where it trades today. So I do think Amazon is fairly or even undervalued. and the near term and the longer term trajectories are pretty aligned. So I remain bullish for Amazon. Google, it has turned down from this wave C target here, which was the 120% extension of this wave A. And now we're looking at potential retrace down to 191, which is not far away, and also potentially even deeper to 182. So that's the 0.23 to 0.38 retrace of this wave 3 to complete the wave 4 low. I think it's unlikely we'll touch the 200-day moving average. There's quite a healthy volume profile supporting this region, and it is the most attractively valued stock among the Max 7s. So I do think investors would be buying the dip here. But right now, it could be trying to reach this retrace zone first before the wave 5 higher. Meta, we have been expecting this wave 4 downside to potentially fill the gap here that was created post earnings, and our minimum target is 724, which is the 0.236 retrace of this wave 3, and it has almost reached that. I think it could get even deeper to the 680s, 700 level. There is a big volume profile here for natural support, so I can't see it falling much lower than this 680 zone. So I do think when it gets to 680 to 700, it is a buy the dip moment for this wave 5 higher. But for now, we can just wait to see if we can get this gap filled first. Microsoft, again, before the earnings, I did suspect that the big money trades were being placed right after this earnings on a very systematic fashion. And I did suspect that block trade could get completed right at this set of earnings. And the pattern did confirm my thesis of that big money trade. So now I'm looking at a potential wave 4 pullback. And I think that block trade is now coming out or even potentially distributing in the near term. And we could reach below 500 for a minimum target. And we're almost there, right? So if we get below 500, we could test 470 quite quickly, given the lack of volume in this region. But overall, I do think there should be one more high in wave 5 this year. And just again, looking at the options market, institutional investors are more bullishly positioned in the individual Max 7 stocks versus the SPY and QQQ. So I don't think people are thinking this is doomsday. We're getting into bear market yet. NVDA, we had a sharp drop yesterday, and it rallied back to almost flat. But the fact that we created new lower low, and this wave 3 was quite stretched and it had acted as resistance in the past 2 weeks, tells me that we could be the path of least resistance is perhaps to the downside, and we're looking at wave 4 target to 158 below, and that could provide the first sign of support. But I will not be surprised if we get to 144 here. And I think that just gives investors an opportunity to onboard for one more high in wave 5. It's hard to see wave 4 substantially below 144, given the large volume profile and buying interest in this region. We might have too many investors buying the dip as we approach this region to hold the levels for support. Tesla, I have been pretty bullish for Tesla in terms of technicals. I don't think the technicals from yesterday was detrimental. We have this trend line all the way from the April low, and it was held yesterday. So we're looking at basically a bigger triangle, a failed breakout from mid-August, now testing this lower trend line. However, my machine learning model doesn't quite like what happened yesterday and judges the overall profile in terms of macro conditions as well as the price action leading up to this point to be more bearish learning, and therefore the model has switched to risk off. So that is a very critical piece of information, and it just gives me a bit less confidence of the bullish course. However, previously the model had switched off for 1 day, and then the price action subsequently has justified to switch back on to risk on the day after, or 2 days after. So this may not be the doomsday scenario for Tesla investors. It's just a critical piece of information that we digest and just leaning a bit more cautious for the overall price pattern. However, if we're looking at the technical analysis alone, we're still inside this wider triangle here, and until it breaks out either way, it's not definitively bullish or bearish here. And just looking at the overall structure in terms of Elliott waves, I still do expect higher highs in the near term. So technicals, I don't think that much have changed, but of course, the critical piece of machine learning signal is switching to risk off for now. I am on holiday next week. I am on holiday from tomorrow onwards, but given the latest price action, I will update my machine learning signals every day for Tesla here, just to keep everyone guided in this market. And if we get the risk on signal, everyone here is first to know. Looking at semis, it just essentially follows NVIDIA's movement. I think we could be getting a wave 4. Previously, I thought we were going to get the wave 4 here, but that ended as a fake move and a new high, and now retesting the lows. If it is wave 4, we're looking at 228 as a minimum target. There's a heavy support in this region, so we might not be able to dip much further than that. Again, we're going to have to follow NVIDIA and AMD for more clues. PLTR, Palantir. Last week's update, we actually highlighted this exact target zone for wave 4, because this wave 3 was getting into a more stretched zone. I didn't really like the risk reward of chasing the long position here. And if we did get into wave 4, I highlighted that 141 to 157 was the initial target for wave 4 correction. And if you look at yesterday's price action, we actually ended the day with the low of the day being 142. So that was pretty much as close as you can get in terms of technical analysis on the right support levels. Now, does that mean we're going to see sustained move up straight away? I think it's unclear at this moment. We might get some follow through, and we could try to spend more days consolidating here. And even for a deeper pullback, we can still see a bounce and then moving towards the lower end of a wave 4 pullback, which is the 50% retrace of wave 3 at the 130 level. I do think that if we do get there, it could be an attractive dip buying opportunity for this wave 5. So the overall structure still suggests that there should be one more wave higher to go in these 5 waves. And our machine learning model is still risk on at the moment after what happened yesterday. So for now, we are still in a bullish uptrend overall. That hasn't been broken. And I think further weaknesses should be looked at as buying opportunities for now. Unless, of course, you care about the fundamentals and this stock is at a sky-high valuation that really cannot be justified by its growth. And I'll say the same thing about Tesla and also in the case of Apple as well. In terms of technicals, I'm still in a bullish uptrend mode. And in terms of fundamentals, I would say the stock doesn't really trade against it, and just pick your spot for shorting stock. That's if that's your thing.